Hello everyone, welcome to today's lecture. So today we are going to talk about SA 265, SA 299 and 300. Okay, so I request you guys to post the queries if you have anything from the previous lecture, or with respect to this lecture, if you have any queries or any questions, you can post it on the same time, on the app, and I will be taking up those queries. Okay, great. Let's start the session. So guys, let's talk about SA 265. Now, how SA 265 works, what is the role of SA 265? So, SA 265 is something like communicating deficiencies in an internal control to those charged with governance and management. Now, you will be saying that, okay, we just now saw this essay yesterday. That was 260. So what is the difference then between 260 and 265? Okay, I'll tell you. So when I talk about SA 260, okay, it is something related to discussing and communicating the issues to the management, to the those charged with governments, not management. That's the SA 260. If you remember the name, that is communication with those charged with governance, and there is a specific communications or some items of significant difficulties, audit planning, independence, everything. Those are the items which are communicated as per that essay. Now, when I talk about essay 265, it talks about communicating with those charged with governance and management, both. Okay, but about what? Specifically about deficiencies in internal control, or significant deficiencies that we'll see. Okay, so that is the difference between SA 260 and 265. I'll write it down here. When I talk about SA 260, that says that you need to communicate with those charged with governance, and communication means for specified matters that is there in the essay itself. Okay, but when I talk about essay 265, it says communication with those charged with governance plus management. Now that is something about deficiencies in internal controls. Okay, deficiency in internal control. That is the difference. Okay. Now, to understand this particular thing, we need to understand two things. One, how we will be communicating. So communicating deficiencies, how? Number two, what we call a deficiency in internal control system or internal controls. Okay. So communicating deficiencies and how we will be communicating. So these two things I'll say that we will be focusing upon in this essay. And if we understand these things, then we will be covering majority of the essay. Okay. Let's see the objective. What is the objective of this particular standard is? Auditor is to communicate appropriately to management and those charged with governance deficiencies in internal control that the auditor has identified. We know through even the name of the standard itself, we can figure it out. This one, fine. Now, we need to understand what are the deficiencies in the internal control. Okay. So, when I talk about deficiency, remember previously I presented one diagram, handmade diagram. Over there we were talking about deficiencies in internal control. Okay. Now see, the rain over here is a risk. Risk can be any type, of any type. I'll say this risk is of material misstatement. This risk is of material misstatement. Okay. Now, when this risk falls down, my internal control, that is an umbrella in this, the current case, has some holes. That's a deficiency. This deficiency, can be significant, cannot be a significant, might not be a significant. But how to identify whether this is a significant or not is by the amount of water that is coming from the deficiency, that hole. Okay. If the amount of water together coming from other holes in that umbrella is huge, is too much to handle, then the deficiencies together are significant deficiencies. But if the amount of water coming from those holes is not that much, it's some few drops, that's fine. So in that case, I will not call as a significant deficiency. Okay. So deficiencies are nothing but the holes in the internal control, you can say, or anything where internal control is not able to restrict your risk or exposure to the risk. That is your deficiency in simple terms. Okay. So let me go back to our notes. So deficiencies, okay, is equivalent to risk not addressed by internal controls. If the controls are not effective, are not operating effectively, are not designed effectively, in those cases that becomes a deficiency. Okay. So risk not addressed by control, or I can say when a control is designed to prevent or detect some misstatement, but it is unable to prevent / detect that misstatement. Okay, is unable to prevent or detect misstatement in a financial statement on timely basis. That is my deficiency in internal control. Now, when I say unable to prevent, that is in my example that I showed you, unable to prevent is unable to stop or prevent the water from coming down. Okay, if your umbrella is unable to prevent the water, to pass through the umbrella, it's unable to stop the water, then there is a deficiency in that internal control. Okay, so that is deficiency. Now, what is significant deficiency? Significant deficiencies. Now, significant deficiency is nothing but combination of deficiencies. Combination of deficiencies that require that is of sufficient importance, or that is of that much you can say quantum, that has that much magnitude, likelihood, so that requires immediate attention. So you can say combination of deficiencies of sufficient importance, okay, of sufficient importance to merit the attention. Means this is something which requires your attention immediately. A combination of deficiencies which require your attention immediately, that is a significant deficiencies. So in our example, when I say there is a hole, 1, 2, 3, 4, 5, five holes together can make a significant deficiency, but standalone on one single hole may not make a deficiency, a significant deficiency. So combination of individual holes in the umbrella together, so that it is important, or it's something like, which requires my attention. Okay, there are multiple holes in my umbrella. This requires my attention. That is significant deficiencies. Clear? Okay. So once you identify significant deficiencies, you need to communicate to the management or those charged with governance. Let us see. So this essay says that identify whether there are any deficiencies in internal control is present by performing audit, understand whether individually or in combination they constitute significant deficiencies, and then communicate to the respective stakeholders. Communicate to the respective stakeholders. So first of all, you need to identify whether their deficiencies are. Then you need to perform audit procedures, and then based on that, you need to communicate. Okay. I understood. Okay, fine. I'll identify, then I'll perform my work, and individually and together I'll understand whether they constitute or significant deficiencies or not, and then I'll communicate. Fine. Now, I need to communicate on a timely basis, because if I communicate after 2 years of identifying deficiency, then there is of no use. If I identify deficiency today and if I communicate after 2 years, then what is the use of communication? So I need to communicate on timely basis. Time is of very importance everywhere. Okay. So when I need to communicate on the timely basis, okay, how I need to communicate? I need to communicate in writing that significant deficiencies in internal control are there. Okay, unless and until is it not appropriate or inappropriate to communicate directly. Okay, so there might be some conditions, or where it is related to the fraud, or something where the management is self involved. But otherwise we need to communicate to them in writing. Okay. Other than this, what we are required to communicate is, so we are first required to communicate significant deficiencies. Then, other than significant deficiencies, there is something more that we are required to communicate. That is, other deficiencies in internal control. Other deficiencies in internal control that are not being communicated. That have not been communicated to management by other parties. Okay. Not been communicated to management by other parties, and are of sufficient importance. Means there are some small holes in the internal control in the umbrella that have not been communicated to management by anyone till now. Now, when I say other parties, what are these other parties? Who can be the other parties who can communicate deficiencies to the management? So you tell me, what do you think? Who can be the other parties here? Any example? Who can be the other parties here? Any example? You can give me any example, whatever comes to your mind. Come on, guys. Okay, Jay, good. Any other example, guys? So we received two example, government employees. Now, any other? Okay. So other parties may involve, like as you said, employees, or basically, if I say other parties, you can say internal auditors, because internal auditors' role is also to identify deficiencies in internal control. If other parties like internal auditors, or it may be someone hired specifically, or some like as I said, that someone who is entrusted or who is given this task to identify and communicate other deficiencies. Now, if that person, okay, is not communicating or has not communicated or identified other deficiencies, then it will be our responsibility to communicate those other deficiencies in internal control to management that are of sufficient importance. Okay, so that is with respect to the other deficiencies. So let us see now the requirement. So communication of deficiencies in internal control, to who to communicate and what to communicate, that is we need to see. So we are required to communicate significant deficiencies in internal control, communicate to those charged with governance on timely basis, communicate to management unless it is inappropriate to do so. So think about management, whether it is appropriate to communicate to the management. Now, in certain cases, it might not be appropriate, as I said earlier. That depends upon case to case basis, when it is appropriate, when it is not appropriate. But usually, what happens is at times when management might himself is involved or management is aware, so at that time it becomes inappropriate to communicate to the management. Okay, but other than that. You are required to communicate significant deficiencies in internal control to management. Okay. However, let's say, for example, if there is a fraud and the internal control was not able to prevent this fraud, or was not able to detect the fraud, then in that case, what will happen is, in that case, you will not be able to report that fraud to the management reason, because what will happen is, like, management is involved in that particular fraud. Now, if management is involved in that particular fraud, then it is not good to communicate that particular fraud to the management itself. Okay, management, you are involved in this fraud, I know and I have identified. It's not appropriate. So that's why in some cases it might not be appropriate to communicate to the management. Clear? Okay. Second thing that we are required to communicate is other deficiencies in internal control. And that we are required to communicate to the management if it has not been communicated to the management. Other deficiencies in internal control, communicate to the management if it has not been communicated by any other party. Okay? So, that's the requirement of this particular standard. Now, what we are required to communicate, in the way we are required to communicate is a description of the deficiencies and an explanation of their potential effects. Like, what is a deficiency? Like, it's a hole in the umbrella. Umbrella is torn from there. Umbrella is not working appropriately, it's not opening up appropriately, whatever deficiency it is in the internal control. Okay, so deficiency in the internal control and explanation of their potential effects. If the auditor has communicated deficiency in internal control other than significant deficiencies to management in prior period, okay, and management has not chosen to remedy them for a cost or other reason, then the auditor is not required to repeat the communication for the current period. Let's say, for example, I'll show you an example. Let's say in quarter 1 FY22, I communicated to the management that your fixed asset addition control, fixed asset addition control, that is internal control placed on the fixed asset addition process. Sorry. Okay. Internal control placed on the fixed asset addition process, that is fixed asset addition control, is not operating effectively. Now I gave them the reason why. The reason why it is not operating effectively is there are no approvals, okay, before someone enters the fixed asset in the ERP. Means no approvals are taken before someone enters the fixed asset in ERP. So there was a twofold risk over here. One, fixed asset addition are not appropriately entered into ERP. Second risk, fake fixed assets might be entered into ERP. So there were two risks that, okay, fixed asset additions are not appropriately entered into the ERP. Let's say there was an addition of rupees 100, but someone while entered rupees 1000. So because there were no approvals, there was no review before someone enters the fixed asset into the ERP. That's why these two risks were not addressed. And I said, okay, there is a very big deficiency. I will make this as a significant deficiency. This control is not working. Management agreed. Said, fine, okay, we agree. This control does not work. We will rectify this control. From Q1 till Q4 FY22, I checked, and the same deficiencies were still present. Should I communicate to the management again with all detail that there is a deficiency in the internal control? Answer is no. Once if I have already communicated to the management and management has chosen not to rectify because of whatever reason management has chosen, okay, they will not rectify, then in that case, I'm not required to repeat the information about such deficiencies, which are already previously communicated to the management or in those charged with governance. Okay. Now, these deficiencies which are already communicated to those charged with governance, okay, for their remediation, they already know, like through our previous letters or through our previous details. But that is not necessary that we communicate every time same thing again and again. That is of no point. Okay. So we are not required to communicate same thing till the time, like it's not communicated. Okay. Then the auditor is also not required to repeat information about such deficiencies if it has been previously communicated to the management by other parties, such as internal auditors or regulators, unless there is a change in the management. So, for example, let's say this particular one, this particular example, deficiency in the fixed asset internal control was already communicated to the management by internal auditors. Are we required to repeat this communication? Answer is no. We cannot, just like, okay, there were 10 items in the internal audit report, copy that in your report and present to the management. No point of doing that. So do not repeat if someone has already communicated to the management, okay, these are the things that have been already communicated. We are not required to communicate those, things again if it has been communicated by someone else. Again, so first, you are not required to communicate to the management the deficiencies you have already communicated in prior periods, but they are not chosen to, rectify those deficiencies. Number two, you are again not required to communicate things which are already communicated by someone else, unless and until there's a change in the management. Okay, understood? Any doubt? However, if there is a change in the deficiency or if there is a change in the situation, which changes the type of deficiency, nature of deficiency, impact of deficiency, then it will become your responsibility to communicate. Okay. Any doubt? Now, in some cases, let's say for example, let's say those charged with governance is asking you to communicate the deficiencies which are already communicated to management in prior periods. Okay, those charged with governance is asking you to communicate the deficiencies which are already communicated to management in prior period. Now, what you will do? Will you communicate or will you say that we are not required to communicate? So you have two options. Either you will say, okay, here are the deficiencies, you will provide the list. Or second option, you will say, we are not required to repeat the communication which is already been communicated in past. So we are not required to repeat the communication. You can ask and go and ask a management like what was communicated to them. What you will do? So what you will do in this case? Will you report to management those charged with governance, or you will say go? We are not required to communicate or repeat the communication. Go, you check with the management. Correct, Jen. So you will provide the list, but you will not say like, we are not required to communicate. If those charges governance is asking you the detail, You can either provide them a list in a detail, and if you can provide them, the whole communication that was given to the management last time. But it will not be appropriate to say that we are not required to repeat the communication because someone is asking you, to provide the details. So in that case, it is your responsibility to communicate when there is a specific request from them. Clear? Any doubt? So there is one question: the difference between significant deficiency and other deficiency. So just significant deficiency means combination of deficiencies of sufficient importance to merit the attention. When I say other deficiencies, that is not a significant deficiency. Like let's say normal deficiency, other deficiency basically, standalone deficiency in the internal control. We can say. Any further doubts, guys? Any doubts? See, to make any deficiency, whether the deficiency is significant or not, or whether it requires any attention or not, you need to understand two factors. I'll tell you with an example. Okay. Now, to understand any deficiency, whether this is a significant, other, or of not that much important, I need to understand two things: magnitude of impact, likelihood, okay, of occurrence. Now, low, high, low, high. Okay. If the magnitude and the likelihood of occurrence are high, okay. So let's say, for example, this particular area of the graph, okay, where the magnitude is also high and likelihood is also high. Now, if somewhere at that some place we identify, okay, the magnitude and the likelihood is high, okay, then what will happen is that will become my significant deficiency. I'll show you. Just a minute, give me a minute. I'll show you with an example over here. Okay, let's say this particular example, if my this is a magnitude I can understand. Let's say for this is a magnitude on a particular scale of a graph, and this is a likelihood. So this point over here, this will decide whether the deficiency is significant or not. If my magnitude is high, that is high over here. If my likelihood is high, then the deficiency will become my significant deficiency. Okay. Now, let's say, for example, the magnitude is high, but if I say, okay, likelihood is not that much high. Magnitude is high, I can understand, but the likelihood is not that much high. Then in that case, what will happen is, I will say, okay, this deficiency, this particular green deficiency, okay, represented by green line, will can be other deficiency. Because this has a high magnitude, low likelihood, but still it requires attention because it has a high magnitude. Okay. So any deficiency which requires an attention, but I don't think so that's a significant, because either likelihood or magnitude is not that much great. Then in that case, I'll call that deficiency as the other deficiency. So to answer, like, to identify whether the deficiency is significant or not, I need to identify the magnitude and likelihood of the occurrence. Magnitude, when I say, how do you identify the impact when the deficiency or the risk materialize? Let's say, for example, my fixed asset addition control. Okay, I identified, okay, my fixed asset balance, or not balance, fixed asset additions during the year are, let's say, rupees 50 crores on an average. In a year, the amount of addition I do to my fixed asset is a 50 crores. Okay. Now, there is a likelihood of, let's say, for example, probability of 25%, that the processor will enter fixed asset details wrong. And this 25% is, taken out of, how many instances in my past I have identified. So based on that, I have calculated the probability. So now, let's say, for example, when I will multiply both of them, 50 crore into 25%, how much it will give me? A potential impact, I can look when the control goes fail. When the control fails, this could be a potential impact, 12.5 crore, if this control is not rectified. Now I'll compare with my materiality and I'll identify whether this is material or not. If material, then yes, this standalone will become my significant deficiency. If not material, then I'll check in combination. So, in combination with others, combination with other deficiencies, and if material with other deficiencies, then it will become significant deficiency in combination with others. Now, in combination also, it is not material, then I can call that as a other deficiency. Clear? This is how you identify whether a deficiency is a material or not material, significant or not significant. Okay. Now, other than this, what we are required to, there are two things that we require to communicate to the management. One, about the significant deficiencies to management and those charged with governance. Second, about the other deficiencies that we are required to communicate to the management. Okay, other deficiencies only management, significant deficiencies to those charged with governance and management. Okay. Now, other than this, what we are required to communicate over and above to this, that, okay, what is our responsibility also? Okay, that, okay, this is our responsibility, that we will, understand the internal controls, we will design and test and identify internal controls, and then whatever deficiency will come, we'll report to you. That is something we need to communicate to the those charged with governance. Clear? Okay. Now let us see some of the questions that have been asked on this particular topic, like in the past also, or some MCQs, so that you can have a understanding and detailed clear of the, what you can say, clarity about the topic. Just a minute, let me bring it. Okay. So there is one MCQ. Let us solve this one. During the course of audit, audit of AAPE to fail limited, the engagement manager of the audit team identified the internal control placed over booking of approval and provision is not working efficiently. In their assessment, they identified there was a design inefficiency due to the inherent ERP and system limitation. However, upon discussion with the approval booking team of the entity, they identified the cost involved to remove the ERP and system limitation is around 2.5 CR. Okay, that is rupees 2.5 CR. Okay. Engagement manager reported this issue to the engagement partner in their weekly review meeting. Also, engagement manager provided that the total approval booked for the year was 50 lakhs. Also, the provisional profit for the period for which they were auditing was rupees 25 lakhs. Based on this data, the engagement partner decided not to report this internal control deficiency to management, as the total cost involved in rectifying the issue is more than the benefits they will get. Okay, now you need to select, as an engagement quality control reviewer, please guide and select the appropriate option from below and decide whether the decision made by the engagement partner was correct or not. So so decision made by engagement partner is that, okay, don't communicate. Reason because the cost involved is much higher than compared to the benefit that we are getting. So whether now, before going to the options, I'll understand your point, whether we are required to communicate or not. Come on, guys. Are we required to communicate in the current case? Are we required to communicate? Okay, let us see the options now, and then we'll select the option. Options are: auditor is also responsible for evaluating the cost benefit of the implementing remedial action. Any remedial action that has a more cost involved than the amount of the benefits assumed estimated to be derived should not be implemented and reported to the management, or where appropriate, those charged with governance. Second option: management and those charged with governance may not choose to implement remedial action suggested to them because of the cost and other consideration. However, auditor has a responsibility to report all the deficiencies to the management or those charged with governance. Third, auditor and management should work together to decide whether the said matter can be reported to those charged with governance, and based on the mutual decision, they should perform the reporting. Fourth, all the information collected by engagement manager should be first validated and written representation should be obtained from those charged with governance regarding the cost involved in the remedial action. Once the state representation are sought, then only the state matter should be reported to the management. So what do you think the appropriate answer over here? A, B, C, D. What is the appropriate answer, guys, here? What do you think the appropriate answer is? If you need to select one option, what is the appropriate answer? Correct, Jay. Very good. Come on, guys. Any other answers? Any other answers, guys? Any other answers? Okay. So, in the current case, now, as I said, it is the responsibility of the management to remediate the internal controls. See, what is the responsibility of the management? To maintain the internal controls, to remediate the internal controls if any issue has been identified. Okay, it's a responsibility of management. Now, if something wrong we have identified, then let management decide whether they want to rectify it or not. Our responsibility is to communicate. Now, we need to communicate to the management, and then management needs to decide whether they want to implement the rectify the deficiency or not. That's something upon the management. So, the B option that is there is correct. And let's say A, auditor is responsible for evaluating cost benefit of implementing remedial action. That is not my responsibility. My responsibility is to identify the issue and to provide a suggestion. Now, the cost benefit analysis of the suggestion, that is something management has to do. So this is not correct. Auditor should work together to decide whether the state matter can be reported to those charged with governance. Answer is no. All the information collected by engagement manager should be first validated, and a written representation should be obtained from those charged with governance. No, sorry, not such any requirement. So the correct answer is B. Clear? Okay. Let us solve one more MCQ. Okay. During the course of audit of ABC Limited, Mr. A, manager in audit team, identified that there is significant risk in the lease transaction due to complex cross-border sale and leaseback arrangement. The significant risk or risk of material misstatement was not identified in management's risk assessment process. Upon various inquiries with the management regarding their risk assessment process, it was identified and concluded by the audit team that the management risk assessment process is not effective to identify all the significant risks. Fine. Mr. A is a manager, decided that this, in combination with other potential deficiencies in internal control, constitutes significant deficiencies in internal control, and hence is required to be communicated to those charged with governance. However, engaging partner on the audit of ABC Limited had a different view. According to him, only matters that are actually identified and pose significant deficiencies due to their magnitude are only required to be communicated. Matters of potential misstatement are that are not actually misstatement cannot be termed as a significant deficiencies. You are required to guide with respect to the matters of significant deficiencies that are required to be communicated to with those charges governance. Now the question is that whether potential deficiencies together can be termed as significant deficiencies, means deficiencies which are actually not identified till now. I haven't identified the deficiencies, but there is a potential that there could be a deficiency. Okay. Number two, failure of management's risk assessment, okay, risk assessment process, failure of management risk assessment process or identification of risk, whether it is a, the question will be whether it is a deficiency in internal control. So these are the two questions that you need to answer. One, potential deficiencies together can be termed as a significant deficiencies or not. Second, failure of management risk assessment process, whether it can be a deficiency in internal control or not. Come on, guys, waiting for your answer. Come on. So whether potential deficiencies together can be termed as a significant deficiencies or not. Second, failure of management risk assessment process, whether it is a deficiency or not. So I'll tell you both. First, potential deficiencies together can be termed as significant deficiencies or not. So answer is yes, they can be. It is not necessary that the deficiency should have been identified. If there is a potential that there could be a deficiency of that much magnitude or significance, Yes, then potential deficiencies also could be termed as significant deficiencies which are required to be communicated. Number two, failure of management risk assessment process, whether it's a deficiency in internal control. Yes, it is. Remember the COSO framework? The COSO framework, or the control environment, it says that like there were elements of some framework like control environment, risk assessment, control activities, information communication and monitoring activities. Now the important part is the risk assessment process. If the management risk assessment process, okay, is not appropriate, if the management risk assessment process is not appropriate or not that much effective, then I can say that okay, the internal control over the identification of the risk is not appropriate. What is risk assessment process? Risk assessment process is nothing but internal control placed toward the identification of the risk by the management. That is management risk assessment process, and that's also a type of internal control. And when I say that internal control is not working appropriately, or I identify okay, that particular control, that is ineffective entity's risk assessment process is not is ineffective, then in that case that is a indicator that there is a significant deficiency in the internal control. So in both of the cases, answer is yes. Clear? Any doubt, guys? Any doubt? Let us see one of the questions that was asked in the past exam. Okay, so let me bring it to the screen. So this was asked in the past exam. Auditors are required to obtain an understanding of the internal control relevant to the audit when identifying and assessing its effectiveness and the risk of material misstatement. During the course of audit of APC Limited, you observe that significant deficiency exists in the internal control system and you want to ascertain the same. Elucidate the various indicators of significant deficiencies which will help you in assessing the efficiency of internal control system of the organization. Okay. So now, as per SA 265, communicating deficiencies in internal control to those charged with governance and management, indicators of significant deficiencies in the internal control include, for example, evidence of ineffective aspects of the control environment, such as indication that significant transactions in which management is financially interested are not being appropriately scrutinized by those charged with governance. Identification of management fraud, management failure to implement appropriate remedial action. Remember the ERP example. Absence of a risk assessment process within the entity where such process would ordinarily be expected to have established. Evidence of an ineffective entity's risk assessment process, such as a management failure to identify a risk of material misstatement that the auditor would expect entities risk assessment process to have identified. My another example on management's risk assessment process. If this process is not there, then I can say there is a deficiency, significant deficiency in internal control. Evidence of ineffective response to the identified risk. Management misstatement detected by the auditor's procedure that were not prevented or detected or corrected by the entity's internal control. Okay, So let's say, for example, fixed asset example. Okay, fixed asset addition 1. Disclosure of a material misstatement due to error or fraud as prior period item in the current year's statement of profit and loss account. Evidence of management inability to oversee the preparation of financial statement. So these are certain examples where I can say, okay, there is a evidence available of the significant deficiencies in internal control. Understood, guys? So these are certain examples which say that, okay, there is a significant deficiencies in internal controls. Okay, let us take one more question. Let me bring it to the screen. See, the more questions I'm trying to cover more questions so that you can have a clarity how the things are asked in exam and how you need to answer them. Okay. The important point over here is to understand what is asked. If you can understand what is asked based on, you can easily answer those questions, and that's something we are already covering over here. So yeah, just a minute, let me bring it to the screen. CAN has been appointed as an auditor of TRP Limited. While conducting the audit, he has identified some deficiencies in internal control. He needs to determine whether a deficiency or a combination of deficiencies in internal control constitute a significant deficiency and has to communicate them in writing to those charged with governance and management on a timely basis. Guide CAN with some examples of matter to be considered while determining significant deficiency in internal control with relevant essay. Okay. As per SA 265, communicating deficiencies in internal control to those charged with governance and management. Significant deficiencies in internal control means a deficiency or a combination of deficiency in internal control that, in the auditor's professional judgment, is of sufficient importance to merit the attention of those charged with governance. Okay. Now you need to give certain examples, okay, which can be constituted as a significant deficiencies. Okay, let us see certain examples. The likelihood of deficiencies leading to material misstatement in the financial statement in future. That's the potential deficiency I'm talking about in future. So again, the point I covered, potential deficiency. The susceptibility to loss or fraud of the related asset or liability. The subjectivity and complexity of determining estimated amounts such as fair value accounting estimates. Financial statement amounts exposed to the deficiencies. The volume of activity that has occurred or could occur in the account balance or class of transaction exposed to the deficiencies or deficiencies. Importance of the control to the financial reporting process, like whether it's the general monitoring control such as oversight control over prevention or detection of fraud, okay, control over selection and application of significant accounting policies, control over significant transactions with related parties, control over significant transactions with outside entities normal course of business, control over period and financial reporting process. Okay, now these are certain controls which are of important nature. If any there is a issue in these control, I could say, okay, there is an issue, or there could be you can say significant deficiency. The cause, frequency of the expectation detected as a result of deficiency in the control, the interaction of the deficiency with other deficiency in the internal control. So all these things together determine whether a deficiency is a significant deficiency or not. Clear? Any doubt? So there is one question. Are we required to perform our own risk assessment procedure? Answer is yes. As per SA 315, you are required to perform your own risk assessment procedure irrespective of the risk assessment procedure performed by the management. Any question, guys? Any questions? Any questions, guys, with related to SA 265? Okay. Can you just provide Jay, what is not clear in that so that I can explain much better? See, these previous two questions that I as of now discussed, what is the important over here? What is asked is various indicators of significant deficiencies, like you are required to provide some examples. Second, some examples of the matters to be considered while determining significant deficiencies. Okay, so in first it was asked indicators which can point towards the significant deficiencies. In second, some examples of the matters while considering the significant deficiency, means some examples, okay, this can constitute a significant deficiency. So here see examples of the matters may be considered in determining whether a deficiency or a combination of deficiency in internal control constitute a significant deficiency. So these are certain examples. Over here also, if you see, indicators of significant deficiencies and internal control include, for example, these following things. Now these are indicators. So this is the difference between both questions. And if you have the concept clear, you can easily provide the examples. I hope I'm clear. Any further doubt? Any further doubt, guys? See, please ask if you don't understand. Okay, take the benefit of these sessions and ask as much as you can. If you are not able to understand, then ask freely. Okay, what is this thing we are not able to understand? Then only you will come to know. Okay, what we are discussing over here, and it might be it may happen that at the first instance it might confuse you. That's normal. But in that case, ask. That's the only request I will have with you guys. Okay. If no further questions, then I'll shift to the next standard for today. SA 299. Okay. Before starting this standard, first understand what is the requirement over here? Okay. SA 299, joint audit of a financial statement. When I say joint audit of a financial statement, I'll show you with an example, with a story. Okay. Let's say, for example, remember in the start of the sessions on the standards, I told you one story about me and my friend. That me and my friend were, given an assignment of audit, let's say audit of ABC Limited. Okay. At that time, we were provided with this assignment, and we were, asked, okay, to carry out the audit of that particular assignment. Let's say, for example, I'll explain you with example. Let's say myself and my friend okay, let's say Mr. A. Myself and Mr. A were given audit of ABC Limited. Now he asked me, friend, that okay, we are given the assignment of ABC Limited, audit of ABC Limited. What should we do? I told him, okay, do one thing. First of all, you understand the entity. Okay. You understand the entity. So we divided, okay, what we are going to do. So I said, okay, fine, let's prepare a list that I am going to do, and let's prepare a list that you are going to do with respect to this thing. If I am going to do everything, I'll take the whole fee. If you want the part and the fee, you have to do some work. You have to, perform some activity. I said, fine. He said, fine, okay. We'll bifurcate equally. I said, fine. I said, okay. I understand the laws and regulations. You understand the process. Then I said, okay, I'll take the liability side of balance sheet. I said him to you take asset side of balance sheet. I said, okay, I'll look into the expenses. I told him you look into the revenue of P&L. Okay. Then I said, okay, with respect to the application of Ind AS, we'll both see whether Ind AS are applied properly or not. I said, fine, we'll both see, because in some of the Ind AS, he's expert, in some of the Ind AS, I am expert. Okay, fine. Let's see, together. So we decided our areas. Fine. Now, by deciding our areas, what we did is, he said, okay, we'll bring our teams together and we'll conduct a meeting. So we both brought our teams to discuss the above bifurcation, that I will do liability, expense, and laws and regulations. He will understand the process, asset, and revenue. We said, fine, okay. Our team agreed. This is good, very good. We are happy. We will start our work. I said, very good. Okay. Then what happened is, during the course of to start the audits, we went to the management. We said, management, we have learned something about SA. We have learned that before starting any engagement, we need to do client's acceptance and continuous processes. So we need to agree the terms first to give us the engagement letter. You sign the engagement letter and agree the terms of engagement. Okay. I said, okay, you sign the engagement letter and agree the terms of engagement, because SA 210 says that you need to agree the terms. Correct? If I'm not wrong. Remember something that we discussed in past lecture? Agreeing the terms of engagement? Okay. Now, management said fine. Management said, okay, I will give you an engagement letter, and Mr. A, and I will give Mr. A different engagement letter, okay, with his name and according to his areas and everything. So I'll mention in engagement letter that he will do these areas, and in your engagement letter, I will mention your areas. I said no. Why this partiality? Why two engagement letters? No, this is not allowed. I don't want any partiality, biasness, and anything. You give one engagement letter that should contain both of the details. Okay, so as I asked them, you give me one engagement letter. The condition should be same for both of us. Why you giving favorable condition to him and not favorable condition to me? We should have same conditions. Fine. Okay. We will have same conditions. Management agreed and they provided us one engagement letter. Okay. After getting that engagement letter, we started our work. We started looking into the things, the areas that we decided together, and we decided that we will be testing on a standalone basis. Okay, fine. Now, once it was done, once we agreed, we started the audit. What we did is, let's say for example, we were doing testing and we were doing, all the testings, all the procedures that were there. So management came to us. Management asked us, okay guys, tell me who one is responsible for the asset out of you? Who is responsible for assets? So I said, responsibility for the asset is Mr. A. Mr. A told, no, we are together responsible. We are, doing audit together. I said, why? Why we are together responsible? Last time when I asked you what you will do, you told me that you will do asset. I said, I will do liability. Then why I am responsible for the liability? I said, no, not accepted. I am only responsible for areas that I have selected to perform. That was agreed earlier. Like you are paying me for liabilities, why I should take responsibility for assets? That is something you are getting paid for. So only areas where I have agreed with my responsibility and that is agreed between us, I will be responsible for that area. I will say to management, please go to him for asset. He is responsible. I am not responsible. Management said, okay, fine. Now after doing everything, okay, it was time to issue audit report. So what Mr. A, my friend, told me, let's issue separate audit reports. I said, why to issue separate audit reports? He said, I'll issue the audit report for liabilities. Oh, sorry. I need to issue audit report for liabilities, laws and regulations and expenses. He said he will issue for asset and revenue. I said, okay, let's do one thing. Let's issue together one audit report. And we'll mention our areas. We agreed, okay, fine, one audit report. Okay. Then, with respect to one audit report, there was one of the area that we were both together looking, that was Ind AS. Now, he was saying that in financial statement are as per Ind AS. So, Mr. A and myself. As per Mr. A, Ind AS compliance, he was saying it is good, appropriately fine. Ind AS has been compliant. I said no. Ind AS are not compliant. My knowledge is good here. So understand that, I have some additional knowledge in Ind AS and for this particular startup. He was not agreeing. He said, no, I don't have less knowledge than you. Ind AS is compliant. You are wrong. So we had some, discussions and we had a difference in opinion. He had some difference in opinion. Now, he said, okay, till the time difference of opinion is there, we will not issue audit report. I said, why? Why? The client will kill us. If you will not issue the audit report on the time, the client will come to you and will kill you. What should we do? So he said, okay, I am the senior. I have more year of experience. My say will go and my audit report will be final. So I was wondering whether I can allow this because, if he's senior and if he's issuing some audit report where there's a difference of opinion, what should I do in this case? Like, he's my friend, he's senior, I have to listen to him. So what I did is, I said, okay, you issue whatever you want. Okay, you issue your audit report. So he issued his audit report. What I did is, I issued my own. Issued my audit report where there was a difference of opinion. Okay, where there was a difference of opinion. And I provided a reference to his audit report and he provided reference to my audit report. Matter closed. Okay, so we issued together two different audit reports. Now, from all this story, I will correlate the standard and I'll provide you, I'll try to simplify the things. So, when I talk about joint audit of financial statement, is nothing but, it lays down the principle for conducting joint audits by the auditor. Okay, joint auditors. So when I use the word JA, it's a joint auditors. Okay, so objective of this standard is to lay down broad principles for the joint auditors in conducting the joint audit, to provide a uniform approach to the process of the joint audit. See, while doing the joint audit, so many issues we encounter. What you will do, what I will do, for which you will be responsible, for what item I will be responsible, how to issue audit report in case of joint audits. So there are a lot of things that are required to be discussed. Okay, to identify the distinct areas of the work and coverage thereof by each joint auditor, and to identify individual responsibility and joint responsibility of the joint auditors in relation to the audit. So all these things are provided by this particular standard. Okay. Now, audit planning, risk assessment, and allocation of work with respect to the joint auditor. Joint audit. So, as per the standard, engagement partner and other key members from each of the joint auditor are required to be involved in the planning of audit. Remember when we discuss about this here, like what we will do, what he will do, I called my teams, I informed my teams, okay, come together, we'll discuss this, and I informed them, okay, this is the thing that we are doing. So my team and Mr. A's team came together and we discussed some items. That is, bringing the team into the planning and, discussing these items. Joint auditors shall establish the overall audit strategy that sets the scope, timing, and direction. Like you will do revenue, I will do expense, you will do asset, I will do reliability. If a joint auditor come across matters that are relevant to the areas of responsibility of other joint auditors, then matters should be communicated to the all joint auditors. Let's say, for example, while doing the liability, something came up to me, related to the revenue. So revenue was done by other joint auditor, that is Mr. A. So it is my responsibility to communicate to Mr. A. Mr. A, there is something I have identified in the revenue. You should go and look into that. Okay, so that is something, responsibility of a one joint auditor if they identify something with respect to the other joint auditors area. It is the responsibility of each joint auditors to study and evaluate prevailing system of internal control and assessment of risk relating to the areas of work allocated to the same joint auditor. So let's say, for example, if I am taking expense, it is my responsibility to evaluate the internal controls around the expense and risk present in the area of expenses. And for him, it will be revenue and assets. Clear? Any doubt till now with respect to the planning and risk assessment process in the case of joint audit? Any doubt, guys? See, I will be correlating each and every phase with my example, but any doubt till now? Any doubt? No. So, Jay, if, let's say, for example, if the deficiency, so the question is, if Mr. A does not look at the deficiency that is pointed out by me, okay, that pertains to his area, then should I look into that deficiency? See, now let's say, for example, assets. That was something, to him. Now, if I have identified any of the deficiency with related to the asset, I need to communicate to him. But after communicating, it will be his responsibility to look into that. It will not be my responsibility to address that particular deficiency and to perform the audit procedures around that deficiency, unless that's something related to my area also. I hope I am clear. So if something is not related to my area, then I'm not responsible to look into that. I'll let the other auditor whose responsibility it is to look into that particular area. Any doubts, guys? Any doubt? So if no further doubts, what we can do is like we can take a quick break and we'll be gather, coming back at 10 minutes. Okay, let's take a quick break of 10 minutes. Hello everyone, welcome back. Okay, let's continue the topic. So, we were talking about before the break the joint responsibility of joint auditors in a financial state audit of a financial statement. With my example, remember I was talking about how me and my friend Mr. A divided the work. Okay, now development of a joint audit plan. Okay, so with respect to the development of joint audit plan, we need to identify which areas that I will be doing, which areas he will be doing, and which will be the common areas. So identify the division of the audit areas and common audit areas among the joint auditors. That he will do asset, I will do liability, he will do revenue, I will do expense. That's the bifurcation I need to, keep it here. And common areas like Ind AS, compliance with the Ind AS, financial reporting framework. So all those things we will be keeping there. Then, ascertain the reporting objectives and nature of the communication required. What will the reporting objectives over here is? Like, okay, we are required to report we are required to provide an expression. We are required to provide an opinion. Okay, regarding, we will be giving a reasonable assurance with respect to the whether financial statement are free from material misstatement or not. So that's the something objective we need to establish over here. Then, once we discuss about the objectives and the nature of the communication that will be required during the course of audit, we need to consider and communicate among all the joint auditors the professional judgment taken by them and their factors. Let's say, for example, with respect to some of the areas in the expense side. Now, these expense side areas have direct impact on the asset, or assets have direct impact on the expenses. Let's say, for example, depreciation. Let's say, for example, amortization of lease rentals. Let's say some, amortization of capitalized expenditures. So there is some items on the asset side which directly impact on the expense side. Now, my friend has taken some assumptions. Like he has taken some, professional judgment with respect to some estimates which are there on the asset side, which is direct impact on the expense side. He is required to communicate all those professional judgment with their factors, with their, details to all the joint auditors so that, it might have impact to the other joint auditors also. So it is the responsibility of the joint auditors in the audit to, communicate all the professional judgments that they are taking. Okay. Consider the result of preliminary engagement activities. Client acceptance and continuance. Remember, we went to the client, we asked them engagement letter, he was providing 2 different engagement letter. We thought, okay, we need one single engagement letter, we'll combine the client's acceptance and continuance. Ascertain the nature, timing, and extent of the resource necessary to perform the engagement. How much of the team member I will require, how much of the team member he will require. He needs to do asset, I need to do liability. He might need to go to inventory count, he might need to go to physical count of fixed asset. I might not. So accordingly, the requirement will change. He will require some more person, I will require some, persons who are there at the client place, he requires some person who are at the physical locations. So accordingly, we need to decide how many resources, how much time we need to perform our audit, to perform our audit procedures of our respective, our own areas. That's something very important. Assess risk of material misstatement, communicator to other joint auditors and documents. Let's say, for example, I assess there is a risk of material misstatement with respect to the financial lease transactions that impact my assets, that impact his asset sides. Okay, I identified through the lease expenses that were booked in the expense side. Now, if I say there is an issue with respect to the lease expenses that are shown in the books of account, the next impact will go to the asset side, that the right of use of asset that is there in the asset side. And hence, whatever area or whatever, risk of material misstatement I have identified, I am required to communicate to the other joint auditors in order so that they can, they can be aware about those risk of material misstatement might relate to their area, might not relate to, but that is their responsibility to understand and identify, okay, whether it is related to their area or not. But it's my responsibility to communicate and to document. Discuss the nature, timing, and extent of the audit procedure for common and specific areas and communicate to those charged with governance. Usually, audit plan, audit timing, and the procedure that we are going to cover in the audit, we communicate with those charged with governance. SA 260. In case of a joint auditor, we both will communicate because to both of us, SA 260 will be applicable. Joint auditor shall obtain common engagement letter and common management representation letter. It should not happen that he has a specific engagement letter with specific terms and I have specific engagement letter with specific terms. Okay, that is not done. The partiality, biasness not allowed. You need to have a common engagement letter, common management representation letter. Joint auditors should sign the work allocation sheet and share with those charged with governance. Means this work allocation sheet, okay, you do liability, I do liability, you do asset, I do expenses, you check for the revenue. In this we'll commonly see this is a work allocation sheet. We'll sign this sheet and we'll provide to the management or those charged with governance. Okay. But in actual life, this is a more detailed one, more into detailed summary of each and every phase. Each and every phase will have its own responsibilities. What responsibility Mr. A will have, what responsibility I will have on planning, pre-planning activities, risk assessment, defining the nature, timing, extent of audit procedures, detailed audit procedure for each and every area that I will be performing, he will be performing. There will be some overlapping areas and there will be, what is expected from him, what is expected from me. All those things will be documented. It will be easily, I can say, 30, 40 page document. That is with respect to development of joint audit plan. Okay. Now, responsibilities and coordination among the joint auditors. That is very important. So, responsibilities in case of the areas that are given to that particular joint auditor. Joint auditor is individually responsible for work allocated to such joint auditor, including proper execution to the audit procedure. Means he is individually responsible for the area which is assigned to him or which is agreed that he will be performing work. Joint auditors will be responsible jointly and severally for work not divided between the joint auditors and required to be carried out by all joint auditors. Decision taken by all joint auditors in respect of common areas. Matters brought to the notice of joint auditors by one of them on which all of them agree. Examining compliance of financial statement with relevant statutes. Presentation and disclosure of financial statement as per applicable FRF. Ensuring compliance with relevant statute, applicable SA and other relevant pronouncements. Okay, so these are the areas that where each joint auditor will be severally and jointly responsible. Each joint auditor is required to assume that the other joint auditor has carried out their part of the audit work as per the SA. It shouldn't happen that, okay, I go to Mr. A and say, you have not done your work as per the standard on auditing. You have not checked assets appropriately. I'm not required to review their work. I'm not required to review other joint auditors' work. Reason because other joint auditors, I will assume that the other joint auditors have done their work according to the standards, have done their work according to the procedures or the professional standards they are required to follow. Okay. So I am not required to review the work performed by other joint auditors or perform any test on the sample basis. So let's say, for example, Mr. A has verified the assets. I'll not go again and verify the asset, even on the sample basis. I'll not check, okay, whether he has done the appropriate work or not. He's a chartered accountant, I'm a chartered accountant. He has the same level of knowledge that I have. So I need to assume that he has done the work as per the professional standards applicable to him. Not, like he will assume that I have done the work according to the professional standards that are applicable to me. Other joint auditors have informed joint auditors notice any departure from any applicable FRF or significant observations. So, if there is any departure, I need to bring to the attention of other joint auditor. And before finalizing, all joint auditors should discuss their findings and work done so that a better communication can happen. Okay. Now, with respect to the reporting, the joint auditors are required to issue common audit report. Okay. In case there is a disagreement between joint auditors, they shall express their opinion in a separate audit report. Remember, there was a difference of opinion between Mr. A and me. So I issued a separate audit report. Same way, in the case of a joint audit, when there is a disagreement, okay, and you are not able to issue a common audit report, you should issue a separate audit report for the disagreement. A joint auditor is not bound by the views of the majority or seniority. Let's say, for example, Mr. A came to me and said, I am senior, you need to agree what I am saying. No, not necessary. Even there are, let's say, 4 joint auditors, A, B, C, D. And B, C, D says that, okay, we agree on this. A, on a standalone basis, does not agree. It is not necessary that majority wins. No. If A has some different opinion, he can issue a different audit report. So, CAR, to make reference of SAR. SAR is a separate audit report. CAR is a common audit report. So, common audit report to have a reference of a separate audit report and separate audit report to provide reference of common audit report. So, let's say, for example, there was a common audit report issued by B, C, D. Let's say an example. B, C, and D issued common audit report, that is CAR as of now, but A issued separate audit report. Okay. Both audit reports should have reference of each other. Both audit reports. And why this happens is when there is a disagreement between the auditors. Like, they say there is a finding, there is a misstatement. One says there is no misstatement. One qualifies his audit report, one do not qualify the audit report. So when there is a disagreement on to reporting part, they will issue a separate audit report. But the common audit report and separate audit report should provide reference to each other. And the reference should be given to SS other matter paragraph that we will see as per SS 706. When joint auditor is expected to modify or include other matters paragraph, emphasis of matter paragraph or other matter paragraph in audit report, then they are required to communicate the proposed wording and the reason with the those charged with governance for such inclusion. Again, as per SA 260, you need to communicate with the those charged with governance for the content and the form of your audit report. If there's any, changes in the content and the form of the audit report, like including EOM, modifying your audit report, including other matter paragraph, same. That is with related to the joint audits and the responsibilities of the joint auditors. Any doubt? Any doubt? Any doubt, guys? With respect to the SA 299? No? Let's solve some MCQs then. Let's see. ABC and Company, DEF and Associate, and GHI and Company were appointed as an auditor of Too Big Limited. All the three joint auditors, after deciding their separate and common areas for the purpose of audit, as per SA 299, designed and executed the necessary audit procedures that were required to collect sufficient and appropriate audit evidence in order to support their opinion over financial statement of company. All the joint auditors, based on the audit procedures performed and evidence collected by them, except ABC and company, concluded that the accounts payable balances, one of the common areas for audit, does not contain any material misstatement which can negatively impact the overall audit opinion. However, ABC and company were of the opinion that the account payables balance is grossly underreported and that will impact significantly the audit opinion. Based on the discussion between all the three joint auditors, it was decided that a single opinion will be issued that is supported by the majority of the joint auditors to the management or where appropriate to those such as governance. Now you are required, what will be your opinion over the reporting of issue identified ABC and company in accounts payable? So here are the options. A joint auditor is bound by the views of majority of the joint auditors regarding the opinion or the matters to be covered in the audit report and shall express the opinion formed by the said majority of the joint auditors in case of a disagreement. Option number B. The joint auditors are required to issue common audit report. However, where the joint auditors are in disagreement, an unmodified opinion should not be issued in a common audit report. The joint auditors are required to issue a common audit report. However, where the joint auditors are in disagreement, no audit report should be issued till the time disagreement is resolved. A joint auditor is not bound by the views of majority of the joint auditors regarding the opinion matter to be covered in the audit report and shall express an opinion formed by the same joint auditor in a separate audit report in case of a disagreement. So which option you will select out of these four? I hope you understood the question. So which option you will select, guys? Which option you will select? Come on, guys, pretty easy. Come on, guys, pretty easy. Which option you will select? Okay. Correct, Priya. Correct, Jay. But from the option which you will select, A, B, C, D. So you need to select one option over here. So in the current case, as I remember discussed, that in case of a disagreement, what they should do is the joint auditor who is having a disagreement can issue a separate audit report, and separate audit report will have the reference of common audit report, and the common audit report will have a reference of separate audit report. Remember? So let's see the options over here and which one is appropriate in that sense. A joint audit is bound by the views of majority. Remember, I discussed it's not bound by the views of majority. So first one is wrong. Second, joint auditors are required to issue a common audit report. However, where joint audits are in disagreement, an unmodified opinion should not be issued. That is wrong. That is not the requirement. It is not the case that, okay, when there is a disagreement, you cannot issue unmodified opinion in a common audit report. That's wrong. A joint auditors are required to issue common audit report, and they cannot issue report till the time the disagreement is resolved. Answer is wrong. A joint auditor is not bound by the majority views, correct, regarding the opinion in matter, and shall express the opinion formed by the said joint auditor in a separate audit report in case of a disagreement. So, separate audit report to be issued when there is a disagreement. This is the correct answer. So, this is the appropriate answer. D. Clear? Any doubt? Okay. On the same line. Okay. There is one more question. Let us see and understand this question. This will enhance our clarity about the topic. Same. ABC Limited, DEF Limited, DEF and Associates, ABC and Company and GHI and Company were appointed auditors of 2 Limited. All the three joint auditors, after deciding the separate and common areas for the purpose of audit, they designed and executed the necessary audit procedures that were required to collect sufficient and appropriate audit evidence in order to support their opinion over the financial statement of the company. All the three joint auditors together issued an unmodified opinion on the financial statement. All the three auditors together issued an unmodified opinion on the financial statement. Okay. After 2 months of the issuance of an opinion by joint auditors, a financial fraud broke out in the company, where it was identified that the company did not report accounts receivable appropriately, and they were overstated by 5 crores. Moreover, it was identified the financial statements were not in compliance with the applicable financial reporting framework. 2 issues. Okay. 2 issues. 1, accounts receivable, they were overstated. Financial statement not in compliance with the applicable financial reporting framework. Okay. In respect to the accounts payable, okay, accounts receivable, inventory and secured loans. So, financial reporting framework was not there with respect to accounts payable, accounts receivable, inventories and secured loans. Okay. Also, 2 Limited, a listed company, was required to prepare and file additional information on stock exchange and SEBI listing as per SEBI listing regulation. However, no such submission was made during the year, which was a non-compliance with the SEBI listing regulations. None of the mentioned issues were identified during the audit of the company, and when inquired with the joint auditors, it was identified that joint auditors did not perform the necessary audit procedures to gather the appropriate and sufficient audit evidence. Moreover, as per the documentation submitted by the joint auditors to SEBI, it was identified that the audit of the accounts payable, receivable, compliance with the SEBI regulations was the responsibility of DEF and Associates. Audit of the inventories was the responsibility of ABC and Company, and audit of secured loan was the responsibility of GHI and Company. Okay. Also, it was identified that while finalizing the audit opinion, none of the engagement partners reviewed the compliance to the applicable financial reporting framework areas, which were not assigned to them. Based on the above identified issues and the evidence, submitted to the SEBI, SEBI issued a show cause notice as to why all the three joint auditors should not be debarred from the performing audit of the listed companies. GHI company has approached to you for assistance in the preparation of the appropriate response to the show cause notice. Now, GHI company has an opinion that they are not responsible for the areas which were not allocated to them during the joint audit, and it posed the responsibility of the remaining two joint auditors to verify the financial statement as per the applicable reporting framework. Now, you need to guide who is responsible for what. Let's say in this case, okay, I'll simplify for you. Areas where the issue was identified: accounts receivable, okay, they were overstated by rupees 5 crore. Financial reporting framework was not complied with respect to accounts receivable, accounts payable, inventory, and secured loan. Okay. Then SEBI listing so compliance with the SEBI listing regulations, SEBI regulations. There was a non-compliance. Okay, submissions were not done. Now, these are the three areas where the issue were identified. Out of these three areas, ABC, DEF, GHI. Okay, so it was identified that accounts payable, accounts receivable, and compliance with SEBI was the responsibility of DEF. Accounts payable, accounts receivable, and SEBI compliance was their responsibility. Then, audit of inventory was the responsibility of ABC and company. Okay, and secured loan was the responsibility of GHI and company. So, inventory and secured loan. Now, you tell me, okay, with respect to this, whether the joint auditor like ABC, DEF, and GHI, DEF is responsible for the areas that he was there. ABC is responsible for the areas that for which he was assigned to, and GHI was responsible for the areas he was assigned to. Agreed? Now, GHI has been also issued a notice by SEBI, okay, where there is a non-compliance with respect to the applicable FRF. Now, you tell me from the options, okay, what is the correct option and why GHI is responsible, and if not, then why not? So let's see the options over here. In respect of the audit work divided among the joint auditors, each joint auditor shall be responsible for the work allocated to such joint auditors, including proper execution audit procedures. Hence, GSI is not responsible for areas assigned to DEF and associates, including compliance with the applicable financial reporting framework as a whole. In respect of the work divided among the joint auditors, each joint auditor shall be responsible only for the work allocated to such joint auditors, where proper execution of the audit procedures is there. Hence, GHI is not responsible for the areas assigned to DEF associates. However, GHI will be responsible jointly and severally for the compliance with the applicable financial reporting framework. One of the all three joint auditors can be held responsible for preparation and presentation and disclosure of financial statement as required by applicable financial reporting framework. Hence, only GHI is responsible for compliance with the applicable financial reporting framework. As there was no material misstatement identified in the secured loans, which was the responsibility of GHI, and hence GHI is not responsible for any of the issues identified. So what is the correct answer? A, B, C, D. Come on guys, what is the correct answer? Come on guys, what is the correct answer over here? A, B, C, D. What do you think is the correct one? Correct, Himanshi. Correct, Himanshi. Come on, guys. What is the correct answer over here? So you need to answer accordingly, like who is responsible for what. We discussed just now this particular topic. Okay, who is responsible for what? Come on, guys, waiting for your answer. Okay, so as I told you that joint auditors are responsible for their individual areas, but we also discussed where the joint auditors are jointly and severally responsible. One of the area was compliant with the financial reporting framework, and hence GHI will be responsible for the compliance with the financial reporting framework as a jointly and severally with all the joint auditors. Okay, so here there was a non-compliance of the financial reporting framework with respect to accounts payable, receivable, inventory, and secured loan. Although there was no misstatement in the secured loans, still GHI will be responsible for the compliance with the applicable financial reporting framework. However, for the areas which are not assigned to him, like accounts receivable, SEBI compliances, GHI will not be held responsible. So the correct option will be B, not A, C, and D. Clear? Because A says that GHI is only responsible with respect to GHI is not responsible. That is wrong. In C, it says that GHI is responsible for like only responsible is GHI, not DEF, not ABC, and hence it's wrong. All the joint auditors are responsible. And in D, it says that he is not responsible. Again, that is also wrong. So the correct answer is B. Clear, guys? Any doubt? Let us see some of the past questions on this particular topic. Okay. NMN and Company and ABC and Associate LLP are the joint statutory auditors of BHS Limited. BHS is a listed entity and has been in existence for last 50 years. Since beginning, this company was audited by MSQ, MQS and Associate, but due to audit rotation, the company had to bring new auditors. Considering the size of the company, two auditors were appointed as joint auditors. Since the company is new to these auditors and concept of joint auditor to whom audit work has been divided, management had a discussion and understood that each joint auditor is responsible only for the work allocated to him, whether or not he has prepared a separate audit report by him. Okay. And you need to advise on that. So what is asked here is whether the joint auditors are responsible only for work allocated to them, whether or not they have prepared a separate report on the work performed by him. So you need to talk about the areas where the joint auditors are jointly and severally responsible also. Okay. And what is the responsibility of joint auditors? So SA 299 deals with the professional responsibility which the auditor undertakes in accepting the appointment as a joint auditor. The joint auditors are required to issue common audit report. However, where the joint auditors are in disagreement with regard to opinion or any matter to be covered by the audit report, they shall express the opinion in separate audit report. Okay. Then, if the joint auditor is not bound by the views of the majority of the other joint auditors regarding the opinion or matter to be covered in the audit report and shall express opinion formed by the said joint auditor in separate audit report in case of a disagreement. Okay. In such case, reference is required to be provided and such reference shall be made under the heading of other matter paragraph as per SA 706. Clear? Then, each joint auditor is entitled to assume that the other joint auditors have carried out their part of the work and they have complied with the standard. Plus, the other joint auditor have to brought out the said joint auditors notice any departure. Okay. Where the financial statement of a branch and division by one auditor, the other auditors are entitled to proceed on the basis of such financial statement. They need to rely upon the work performed by one joint auditor. Okay. So that's the particular thing with respect to the responsibilities of the joint audit in a joint auditor. That was asked in April 19. Clear? Any doubt with respect to this question? Any doubt? No? Yes, financial reporting framework was a common responsibility in earlier example. And why? Reason because it is said that even in the standards still mentioned that there are certain areas where auditors are jointly and severally responsible. One of the areas is the financial reporting framework, compliance with the financial reporting framework. Okay. Let's continue with the next question. Dice Limited appointed two CA firms, MN & Associates and PQ & Company, as joint auditor for conducting the audit of for the year ended 31st March 2019. Okay. In the course of audit, it has been observed that there has been major understatement in the value of inventory. The inventory valuation was looked after MN & Associates, but there was no documentation for the division of work between joint auditors. You need to comment on above. There was no documentation with respect to the responsibility of the division of the work. Who will be responsible for what? Now you tell me who is responsible for what in the current case. Without going into the much detail, you tell me who is responsible for what. There is no documentation available. Then, if no documentation is available, then what should be done? So, responsibility and coordination among joint auditors as per SA 299, okay, which requires that joint auditors are appointed and they should mutually divide the audit work among themselves. Okay. The division of the work usually be in terms of the audit identifiable units, specified areas. In some cases, due to nature of the business entity under audit, such a division of work may not be possible. In such situations, division may be with reference to the items of asset and liabilities or income or expenditure. Okay. Now, in respect of the audit work depending among the joint auditors, each joint auditor is responsible only for the work allocated to him. Whether or not he has prepared a separate audit report of the work performed by him. On the other hand, all the joint auditors are responsible jointly and severally for the audit work which is not divided among the joint auditors, decision taken by all the joint auditors, measures which are brought to the notice of the joint auditors, examining the financial statement of the entity comply with the relevant with the requirements of relevant statutory laws and regulations, presentation and disclosure of financial statement as per the applicable financial reporting framework, ensuring that the audit report complies with the requirement of relevant statute. Okay. Now, in the current case, it was observed that there was a understatement in the value of inventory. An inventory valuation work was looked after MN & Associates. In the view of SA 299, MN & Associate will be held responsible for the same inventory valuation work as it was looked by the MN & Associates only. Further, there is a violation of SA 200 as the division of work was not documented. So, when there is a division of work orally, then we will consider that the division of work is there, that the MN & Associate is the responsible. But on the same time, there is a non-compliance of a standard. That is, documentation was not done for the work allocation of work, and hence once both of these chartered accountants firm will be or joint auditors will be held responsible for non-complying with the standards on auditing. Number two, MN & Associates will be responsible for the inventory valuation. That is the correct answer in the current case. Any doubts, guys? Any doubts? Any doubt with respect to SA 299? If no doubts, let's move to the next standard for our today, that is SA 300. Okay, now our 200 series is over. We'll start with the SA 300. SA 300 says planning and audit of a financial statement. Okay, planning and audit of a financial statement. Basically, this standard is a main stone, or you can say the guiding standard, which talks about how to plan an audit. This provides the base for the audit, how a audit should be planned. Okay, so the objective of this standard is to plan the audit, okay, in such a way that it will be performed in an effective manner. So this standard guides how to plan the audit in such a way that it should, that it should be performed in an effective manner. Okay. Then, what this standard says that requirement of this particular standard that involvement of a key management team member whenever you are planning for an audit. So the engagement partner and other key members of the engagement team shall be involved in the planning and discussion of the audit. They should be part of the audit. Okay. And they should be involved so that they should be aware about what is going to happen and how they are going to conduct the audit. Now, when I talk about SA 220 performing the quality control, SA 210, or that understanding the terms of engagement, why we are required to follow these things? Why it is required that you should follow these standards at the time of planning? The reason because this particular standard, that is SA 300, requires you to comply with the standard SA 210 at the preliminary engagement stage. So this standard provides, okay, these are the standards that you should consider at the preliminary engagement activity stage. And which are those? What are those requirements that we are required to see? That is, perform procedures required by SA 200 regarding the continuance and of the client relationship and the specific audit engagement. Means you need to see whether you can continue the client relationship if you are performing, the audit of that particular client. Okay. Second, evaluate the compliance with ethical requirements, including independence as per SA 220. Third, establishing and understanding the terms of engagement as per SA 210. So this standard requires you to comply with these three things at the preliminary engagement activity stage. Okay, preliminary stage. So this standard says that, okay, when you are performing preliminary activities, you should comply with these things at least, minimum. Okay. Then this standards also provides a list of activities that you are required to do at the planning stage. Which are those activities? At the planning stage, auditor is required to overall, establish the overall audit strategy that defines nature, timing, and extent for the audit. Okay. An auditor shall determine the overall audit strategy that should provide nature, timing, and extent of the audit that you are required to do. Then, if I say nature, timing, and extent, what it shall include, what it shall contain, or when I say overall audit strategy, what is overall audit strategy? What should be the part of overall audit strategy? So when I talk about overall audit strategy, it should include scope of audit engagement, nature of audit engagement, and characteristics of engagement. Whether it's audit of a finance, audit of a listed entity, audit of a private limited company, audit of a NDMC. What is the scope here? Nature of assignment, characteristics of assignment. Ascertain the reporting objectives of the engagement to plan the timing of audit. Okay. Means ascertain reporting objectives, that what are the objectives of this particular engagement. Okay. So what is going to be performed, what we are going to perform in this particular audit, what is the activities that we are going to perform, and accordingly we need to discuss, we need to define our reporting objectives. Okay. So when I talk about reporting objectives means you can say what I am going to report, to whom I am going to report. Okay. What will be the content of the report? So how frequently I am required to report. So, and the communication required. Remember the communication that we are required to do as per SA 260 and 265. So communication for those reporting objectives. Okay. Then consider the factors of the professional judgment which can directly guide the team. You need to consider the factors that are critical and that are necessary for a professional judgment. And you need to provide the guidance to the team throughout the planning. Consider the results of the preliminary engagement activities. Let's say, for example, client acceptance, independence evaluation, ethical compliance. Okay, so these are the certain things that you need to consider the results of this. Let's say, for example, client's acceptance. Now, if there is a threat to some of the fundamental principles, now which says that you cannot accept the client, then because you cannot accept the client, how will you perform the planning activity for that particular client? So you need to consider the result of preliminary engagement activities, okay, and you need to accordingly plan for your audit. You need to accordingly plan the audit activities. Without considering my result of preliminary activities, I cannot plan. Until and unless I am not sure whether I am independent to perform this particular activity, how can I, basically plan for the audit? So result of the preliminary activities is a very, very important thing. Let's say for example, I am required to perform audit of ABC Limited, okay, where I am the majority shareholder. Okay, this I identified during client's acceptance. Now, if this is something I identified during the client acceptance, can I perform the audit? Answer is no, I cannot perform the audit. Then the result of these preliminary engagement activities I need to consider. And if I cannot perform the audit, then what is the purpose of planning? So you need to consider that particular thing. Okay. Define the nature, timing, extent of resource and team. Nature, timing and extent of resource and team means what team you require, like 3 professionals, IT guys, CAs, and what experienced freshers. What is the composition of team that you require? Okay, how many resources, how many team members you'll be requiring, what will be the timing, like how many months they will work upon the engagement with you, who will be associated for how much of the time. Okay, so nature, timing and extent of the resources and the team. Then you need to develop the audit plan that shall include nature, timing and extent of the plan, the risk assessment procedure as per SA 315. Means you need to comply SA 315 and whatever result comes that you need to include in the audit plan. You need to comply with the SA 330 and then you need to include that also into the audit plan. That is nature, timing, extent of the audit procedures, okay, in response to the identified risk. Other procedures that you will perform as per the other SA. Plan, nature, timing and extent of the directions and supervision of team and review of work. Okay, how much of your time, how much you will review. Okay, how much managers will review, how much time you will devote to the review, how in-depth review you will be performing, for which areas. It may happen that, okay, for the BRS you may not perform that much in-depth review compared to the complex estimates and the transactions. So how much of the review and supervision of the team is required, nature, timing and extent, area wise. You will update and change the necessary audit plan according to the risk identification or the plan procedures you will be doing as per SA 330. So it's a continuous process basically. Okay, then what you need to do is, once you do these all activities at the planning stage, okay, you need to document these all things. So you need to document the audit plan. Okay, the auditor shall document the overall audit strategy and the audit plan and any significant changes made during the period. Okay, so these are the things that you are required to consider while preparing the plan for an audit. And this is a requirement of SA 300. So now I'll ask you a few questions. You need to answer those things. Let's see how much of understanding you have gathered by from SA 300, because this is a base for each and every engagement or each and every other standard. That's the starting step of your audit. Okay, so first of all, planning is a one-time activity which is required to be performed at the start of audit engagement. Okay, at the start of audit engagement. Okay, and it is an discrete phase of audit. You need to just provide whether this statement is true or false. Simple. This will ensure that whether you are understanding that whether the concept of planning or not. So come on, guys. This will ensure that okay, whether you understand the concept of planning in an audit or not. Come on, guys. So that will enhance your understanding whether you understood the planning or not. It's a very important phase. Okay, correct, Himanshi. So planning is not a one-time activity. Okay. Planning is not a one-time activity, it's a continuous activity. It goes on. Once you perform a planning means, let's say for example, you will perform a risk assessment. When you start auditing, you will decide resources, time required for audit, resources required. Okay, you will do risk assessment 315. You will design audit procedures to address the risk, that is following SA 330. Okay, then when you will perform the audit procedures, You may gather some evidence because of which you might require to change your audit procedures. Okay, then you will change your audit planning accordingly based on the evidence that you will respond to know evidence that is available. Okay, and accordingly you will evaluate the misstatement and you may perform some additional procedures. So evaluation of misstatement, that is SA 450. Okay, and based on that you may perform the additional audit procedure, you may perform the additional risk assessment, and it goes on till the time you report. Okay, so planning is a continuous activity, it's not a one-time activity of audit. Also, it is not a discrete phase of the audit, it's a part of the audit which goes on continuing. Okay, so planning is not a one-time activity. Clear? Okay. Now, with respect to the planning itself, one more question that is there. Let me ask you. You need to provide which one is more, see, that is something already asked also, but you need to provide which one is more detailed. Okay, audit plan or overall audit strategy, which one is more detailed? Simple. Audit plan or overall audit strategy, which one do you think is a more detailed one? So what do you think? Which one is more detailed? Come on, guys. Which one is more detailed? Pretty simple. Correct, Jay. So plan is more detailed than the strategy. Reason because plan contains what procedures you will perform. Okay, what procedures you will perform and the nature, timing, and extent of the procedures. That's why the audit plan is more detailed than the overall audit strategy, because it includes the nature, timing, extent of the audit procedures that you will be performing and your engagement team will be performing. Okay. Now, most of the time, most of the students face difficulties to understand when I say overall audit strategy, what it includes. Okay. What is like examples, or you can say matters that auditor may consider while establishing the overall audit strategy. Okay. Which are the factors that impact my overall audit strategy? So there are certain factors which impact your overall audit strategy. Like for example, factors impacting overall audit strategy. So these are the factors that will impact your overall audit strategy. When I say overall audit strategy means what I'm going to do, which audit I'm going to perform, what are the characteristics of audit, okay, how much of the time resources I will be taking, okay. So all these things overall, what will be your audit strategy? So first is the characteristics of engagement. Okay, characteristics of the engagement, that what type of engagement it is, what is the financial reporting framework, okay, that is going to be applied, which industry specific requirements it will be applicable, like electricity company, or you can say banking requirements, okay. What is the number of location components you are going to cover? Let's say for example, it is a consolidated financial statement audit, okay, then how many components are there, how many locations are there within the India or location outside India that you are going to cover, okay. Then whether this is the audit of subsidiaries, that's the audit of parent company, then which segments are there in the particular case. So for example, in a bank it will be a loan, not a bank, let's say for example, a company is there which manufactures cars also, two-wheelers also, electrical vehicles also, it manufactures heavy machinery also. So how many segments are there? Then how many currencies are there? Let's say operations outside India will be in your, let's say for example, GBP, pound, euro, USD. Then how many currencies in you are dealing? External commercial borrowings are there. So all these things will determine the characteristics of your engagement, that will determine the overall audit strategy. So that will impact the overall audit strategy. Number 2, reporting objectives. What are the reporting objectives? Let's say it's a quarterly reporting, half yearly reporting, a financial audit of financial statement for full year, okay. How frequently you will be reporting with the management or those charged with governance, okay. The communication you will be doing with that, with them, the way of communication, the writing, the content of the communication, okay. Significant factors from preliminary activities that we already saw, okay. Preliminary activities like client's acceptance, continuance, determination of your independence, whether you are independent or not, ethical compliance. Other than that, there are some other preliminary activities also. Let's say for example, how much of the integrity of the management, we somewhere saw, remember we will see that, okay, integrity of the management or those charged with the governance, organizational structure, how those charged with governance are separate from your management, okay. So these are the certain factors which will impact your overall audit strategy. Okay. Any doubt with respect to any of the requirement of SA 300? Any doubt, guys? So SA 300 talks about planning of an audit, which includes, performing preliminary engagement activities. Planning includes defining the overall audit strategy. Establishing overall audit strategy and preparing for audit plan, developing audit plan. Two things: overall audit strategy, audit plan, and then it provides you that, okay, what all activities you should consider before start of the audit. That is client acceptance, communication with the procedure auditor, as per the ethical requirements. You need to comply with the ethical requirements, and you need to document everything. That is the responsibility, or you can say a requirement of SA 300. Any questions, guys, with respect to SA 300? Okay. You want to understand significant factors from preliminary activities? Okay. So, which are the significant factors from the preliminary activities? I'll tell you. So, basically, what are the preliminary activities? Preliminary activities means, the activities you will be performing before even the planning stage. Okay. So, you will be deciding, okay, your independence. You will see whether you can accept the client or not. Okay, you will see whether you are complying with the ethical requirement, or you need to communicate with the procedure auditor before accepting the engagement. Is there any reason why you should not accept the audit? Okay, you will see whether the integrity of the management or those charged with governance. So there are certain factors that you will consider before start of the planning itself. And those are the preliminary activities, and you will consider the results of the preliminary activities during your planning stage. I hope I'm clear. Any further doubt, guys? Any further doubts? Okay. So there has been few questions on this topic. I'll take up those questions. Okay. Let me bring it on the screen. Okay. There was a question which was like, there was a short note, contents of the audit plan, which was asked. Okay. I'll discuss the answer of that particular question that was for that short note. May not be relevant with respect to this particular, only this topic, but there are few things that, are covered into the audit plan. So, contents of an audit plan. Auditor should develop an audit plan that includes description of nature, timing, and extent of the risk assessment procedures as per SA 315. Okay. Nature, timing, and extent of the plan further audit procedures as per SA 330. Other planned activities and procedures that are required to be carried out so that the engagement complies with the relevant standards. Okay. The plan is a more detailed than the overall audit strategy. It includes the nature, timing, and extent of audit procedures to be performed by engagement team members. Planning for these audit procedures takes over the course of the audit as audit plan for the engagement develops. For example, planning of the auditor risk assessment procedure can occur early in the audit process. However, planning the nature, timing, and extent of the specific further audit procedures depends upon the outcome of those risk assessment procedures. Okay. In addition, the auditor may begin the execution of further audit procedures for some classes of transactions, account balances, and disclosures before planning or all remain further audit procedures. Okay. So that's the content of your audit plan. Basically, overall content of your audit plan. Any doubt with respect to this? Any doubt, guys? Okay. I'll discuss one more question. Just a minute. So somewhere related to the development of an audit plan and the development of an audit strategy. So it's already there in the material provided by the ICI. So CA Samir, after developing the overall audit strategy for Banca Limited, develops an audit plan but finds need to revise the materiality level set earlier, and therefore a deviation from the already set audit strategy is felt necessary. In this case, he should continue the audit plan without considering the audit strategy, drop the audit and withdraw from the engagement, first modify the audit strategy, and thereafter prepare the audit plan according to modify the strategy, devise a new audit plan, and then change the strategy as per the revised plan. What he should do? So, what he should do, basically. Whether he should, continue the audit plan, drop the audit and withdraw from engagement, first modify the audit strategy, and thereafter prepare the audit plan, and devise a new audit plan, and change the strategy as per the revised plan. So he has developed the audit strategy, and he develops an audit plan, but finds to revise the materiality level. So while developing the audit plan, he identified, okay, I need to change the materiality level, and therefore now, he wants to, he is feeling that, okay, there is a change in the audit strategy that he is required to do. What he should do? So strategy is ready, that is required to be changed because there is a change in audit materiality levels. He was developing audit plan, but he stopped in between. The reason because he was supposed to change the materiality level. Now what he should do? And why? The reason is also important. Why he should do that particular activity? See, this is very important. Reason because I'll tell you. You might be aware with the answer because it's already given. But you need to understand why this answer. Reason because first you prepare the overall audit strategy, and based on that you prepare the audit plan. Whenever execution happens, okay, it is based on the plan, and at the end it is related with the strategy, that okay, it is in the line with the overall audit strategy or not. Now let's say for example there is a change that is done which will create difference between this overall strategy and audit plan. Then once after performing the execution, if you are required to change the audit plan as per the audit strategy, you will be not able to do that. You will face difficulties reason because audit strategy and audit plan will not be aligned. In that case, it's always better to modify the audit strategy and thereafter prepare the audit plan according to the modified strategy. If you will not modify the audit strategy, it will be old. This will be new. When you perform the procedure as per the audit plan, and at the later stage, as I said, the planning is a continuous stage. Okay. When you will revise the audit plan, then again you will go to and see the audit strategy. Okay, what is my audit strategy? And then you will do the planning. At that time, this will be old. So it's always better to change the audit strategy first and then revise the planning and do the revised planning. Clear? So the correct answer will be C. You know the answer, but why? This is the reason why. Clear? Any further doubt, guys? Any doubt with respect to today's standard that we covered? Guys, read whatever we are discussing over here. You have a 2-day break. Prepare, the coming standards. Those are very important. SA 315, 320, 330. Also, revise what we have discussed today. All the SS 265, 299 and 300. Okay. Solve as much as questions you can. Come up with your questions in the next lecture. Ask as many as the questions you can. And also provide your feedback. That is very important for us. Okay, please provide your feedback in the mobile app so that we can understand whether you are understanding the lectures, you are getting the things that's as per your requirement, but what additional you need. That's why it's very important for us to understand your feedback. Okay, so please provide your feedback, revise, and come up with your questions in the next lecture. Okay, we'll keep till this much for today's lecture, and we'll start with SA 315, 320 and 330 in the next lecture. So be ready with those essays. Okay guys, thank you for your time. Have a nice day and prepare well.